make this webinar very audience interactive. So please feel free to put your question in the chat box. So I will ask a few questions, and if you have questions, please go ahead. Don't be shy. And always remember, we have a chat box. You can keep writing your questions. Adil, thank you for being here today to help our physician educate and bringing them up to speed, especially this administration change has happened. We have new administration, and if there's anything coming up, so we'll be happy to get some information from you. So I will start with one question that can you please tell why it is important for physician to set up a will and trust?
Assalamu alaikum, Taqi bhai. Thank you for the kind introduction and very happy to be here. So I will start with addressing this question about why it's important to have a will and trust. A will is very important because something as simple as the custody of your children, guardianship of your children, that comes in the will. But in America, what is more important than the will is the trust. And the reason why a trust is important is because if you were to die and you did not have, even if you had a will, but you did not have a trust, what happens is that the state that you live in, they come in, they take control of all your assets, and your estate goes through a very lengthy and a very costly process, which is what we call probate. It's a horrible process. I had to go through it once with a client in Memphis, and it was very bad. So this lengthy and costly probate process can be avoided by simply setting up what we call a revocable trust. Now, another mistake that people make is that after they die, they give their wealth to their children under their individual name. So let's suppose, you die, you give your kids like $1 million each. Now, God forbid, Khuda na khasta, the child goes through a divorce or the child goes through a creditor issue. Those assets get depleted. So what we do is that after you die, separate irrevocable trusts get created for each of the children. These are lifetime irrevocable trusts. So the children still have access to the assets, but in the case of a divorce, in the case of a creditor issue, those assets are protected. So it's very important for this reason to set up a will and to set up a revocable trust.
Excellent. So again, everyone, thank you for joining. And if any question comes in your mind, please put in your chat box. So second question is, Adil, is do any updates need to be made to trust based on a Secure Act 2.0? And if you can a little bit briefly explain what is Secure Act 2.0?
So Secure Act 2.0 was implemented in 2023. Now, basically, what that did was it changed certain rules when it comes to retirement assets being passed on to your children. And so if you had your estate plan, let's say you did have your trust set up, but you had it set up prior to 2023, you do have to get it updated to incorporate the Secure Act 2.0 language. All right. Now, the way that it works with retirement assets, the whole game with retirement assets is to delay paying Uncle Sam the taxes, right? So after you die, the retirement assets go to your wife. She gets it into her IRA account. Then she takes it out gradually over her lifetime. After your wife dies, it goes to the children. And the rule that got changed was that where previously the children had their whole life to take the money out and pay a little bit taxes, now they have to take it out in 10 years and pay the taxes, right? Now, the problem that happens there is that when they take it out in 10 years, there's no divorce protection and there's no creditor protection. So what we do is that we put the provision in the trust so that when the retirement assets come out after 10 years, they still stay inside the trust. So you maintain the divorce protection and the creditor protection for the retirement assets as well, while at the same time preserving that 10-year stretch tax benefit. So this is something that we incorporate in the new trust that we are setting up. But if you have trusts that were set up prior to 2023, you do need to update those to incorporate the Secure Act 2.0 language.
Mhm. So that 10 years is a fixed timeline. That is not changing.
So they have to now, so where previously the kids could take the money out gradually over the rest of their life, little bit life expectancy withdrawal. Now the kids have to take it out over 10 years and Uncle Sam gets paid over 10 years, right?
Mm.
Previously, Uncle Sam would get paid later, but they want money. So they changed this rule that
Yeah.
in 10 years you have to take it out and pay the taxes.
Very nice. Very good. Thank you for updating on that. I have a question from audience. Um, can you explain to the audience why funding of the trust is important?
Okay. Very good question. So a lot of times what we see is that people will set up the trust and they'll feel that, okay, that's it, we are done. Setting up the trust is the most important thing. Now we are fine. Probate will be avoided. That is a big mistake. Setting up the trust document is just 50% of the game. 50% of the game is to complete the funding. Now, what does funding mean? Funding means that all the titles and the beneficiaries need to be updated so that they're in alignment with the trust. So,
I
for example, the house, it will go into the trust. The retirement account, the primary beneficiary will be the spouse, the secondary beneficiary will be the trust. The life insurance, the beneficiary will be the trust. If you have an LLC that you own real estate under, that'll go into the trust. So once you complete the funding of the trust, only then probate will be avoided. So funding of the trust is equally important as setting up the trust in order to avoid the probate.
Okay. Thank you. That's good. I have another question from the group. Is charitable-led annuity trust an important year-end tax saving strategy?
Sure. I mean, we can talk about charitable lead annuity trust. So yes, charitable lead annuity trust is an important tax planning strategy. Basically, the way that this works is that now we are getting close to the end of the year, and a lot of people, have maximized their retirement accounts, and they want to give money for zakat, and they're very charitable minded. This is for those people.
Hmm.
So what you can do is that before December 31st, you can put money in something called a charitable lead annuity trust. Now, let's say you put $200,000 into the charitable lead annuity trust. That is a pre-tax deduction for you, right? So
Hmm.
if your tax bracket, let's say, is 40%, you save $80,000 right there. Now what happens is that the money gets invested. The historic average rate of return of the market is about 10% a year.
Hmm.
So the money gets invested. You have to give 5 to 6% to charity every year for a period of 16 to 17 years. And
Oh,
but the idea is that that will be given from the return that is generated in the portfolio.
I see.
And then at the end of that 15, 16 years, whatever money is left behind comes back to you. So
I
this way, think about it. When you put the money in this year, you got the deduction. You saved money. You put 200,000, you saved $80,000 in taxes if you're in the 40% tax bracket. Then through the returns, you gave some money to charity, some money, it grew your portfolio. And then at the end of the time period, whether it's 16 or 17 years, whatever money is left behind, it just comes back to you, right?
Hmm.
So this is after you've maximized your retirement contributions. If you still need some additional tax deduction this year in 2024, this is a strategy that can be implemented, but it does need to be implemented by December 31st in order for you to get the deduction and benefit from it.
Okay, very good. Thank you. That was very nice. And in our group in JSMUAANA physicians, a lot of us we want to ask you this question that if you want to have a Sharia-based estate planning, how can that be done, and what is the process of doing Sharia-based investment?
Yes, absolutely. So definitely Sharia-based estate planning, we do also get a lot of clients that are very interested in Sharia-based estate planning, and that is something that we do. Our attorneys are very well versed with, and we've taken care of this for many, many
Mm.
physician clients. Now, in Sharia-based estate planning, there are a couple of nuances, and a lot of times we see that people don't realize this. So I'll take 2 or 3 minutes to explain this to you.
Sure.
So first of all, there's an Islamic will. Islamic will, statement of faith, burial directives, those things come in the Islamic will. Now, the second thing is that in the American way of assets being distributed, after you die, everything goes to the spouse, and after the spouse dies, then it goes to the children, right? But in the Islamic way, in the Sharia way, we have a different way of distribution, right? The wife gets 1/8, then the parents get something, then the children the boy gets twice as much as the girl, so there's
Mm.
this whole Islamic way, Sharia way of distributing the assets. So the Islamic way of distributing the assets, we actually put that in the trust document itself. So it gets distributed based on Sharia. So that's one aspect of it. The second aspect of it is that we have to be mindful of certain practicalities of American life. So there are few challenges that come up when we
Mm.
try to do Sharia, but we also want to be practical. So the first is that remember we spoke about the retirement assets. From a
Mm.
tax efficiency point of view, it makes sense to give the retirement assets to the spouse first and then the children because you can delay paying the taxes longer this way. But in the Islamic way, you give it to the children. Children immediately get some of the retirement assets and then they have to pay the taxes fairly quickly within 10 years.
Mm.
So what do we do there is that the retirement assets, we would still distribute it the American way, in that wife first and then the children, but we'll make up for it with other assets so that the whole pie is Islamically
Mm.
distributed in those proportions. The second challenge that we face is for example, the house, right?
Yeah.
If the kids will get married, you have a certain dynamic with your children. When they get married, that dynamic, spouses come in, that dynamic changes, right? That's just the practicality of
Correct.
life. So what we do is we want to build in certain protection for the spouse. So for example, the house, even though it's Islamically distributed, but no one can ask the spouse, the wife or whoever the spouse is, to leave the house during their lifetime. So those type of protections also need to be built in. A lot of times we see that people ignore this. There's an extra level of planning that needs to be done with Sharia compliant estate planning, which we want to make sure is done properly and is discussed with you so you understand these nuances and incorporate it in your estate planning.
And just along the same line, I'm assuming that it's been evaluated by Islamic scholars and stuff that is compliant.
Great. So
Oh,
our attorneys have researched this. There's obviously the Shia school of thought, the Sunni school of thought. So they do it according to both, depending on the client. This is something that our attorneys do extensively. And not all our clients are doing this, but a good chunk of our clients are doing this, and we take care of it for them.
okay. Excellent. Excellent. Thank you for that.
Mhm.
And I have a question from our audience. We have some families that have children with special needs.
Hmm.
So, what type of estate planning should be done for them?
Yeah, so this is, Taki bhai, I've been now in this business for over 21 years. And
Wow.
past few years, we've been helping more and more clients I've been seeing this more and more. And with special needs, we could do a whole webinar based on special needs, but I'll just explain to you a few things that are important. Typically, what I tell families that have children with special needs is that we have to make sure that the planning is done extra carefully, right?
Hmm.
And one of the considerations becomes that when the father and mother are alive, up until both of them are alive, the child is going to be fine. If one of them passes away, child will still be fine. You'll make sure your child is taken care of. The problem happens when both of them are gone.
Mm.
When the problem happens, right? And that's when you need to do
Yeah.
the planning. Now, one of the things that we always want to do is we always want to make sure that the child remains eligible for governmental benefits,
Mm.
which is Medicaid and SSI, Social Security. So the
Right.
child always should remain eligible for governmental benefits. And if you give child too much money in their name, they lose their eligibility. So what we do is that whenever we pass along the assets, remember I told you that after you die, separate irrevocable trusts will get created for each of the children.
Mm.
Now, in this case, for the special needs child, the difference is going to be that their trust is going to be a special needs trust. Now, the
Nice.
difference there is going to be that that special needs trust has that provision whereby they do get the assets and they do get access to the assets, but it preserves their eligibility for governmental benefits.
Nice.
So, so that is why that special needs trust is very important. Sometimes we also talk about getting what we call a second to die life insurance policy, because the reason for that is that when you give money to inheritance to other children who
Mm.
are, successful career-wise, they don't really need whatever you're giving them. So if you give them real estate or you give them stock market money, it's not liquid. They don't really need that, right?
Mm.
But the child with the special needs will need liquid assets.
Oh.
So if you give them, let's say, real estate, which is not liquid, could be problematic. So over there, what we do is that we would do a second to die life insurance policy, which will only pay the death benefit after the second death, and
Mm.
that will be liquid money available. So sometimes we look at that as well.
Interesting. Thank you. Yeah, definitely, I agree with you. This is a growing issue, and you're seeing a lot of them. One of our member wanted to ask you is that we always have heard you talk about, importance of contributing to retirement account. Can you please explain to the audience why this is so important?
Yeah. So the contributing to a retirement account is important for three main reasons, right? The first reason is that for every $10,000 that you put into a retirement account, if
Oh.
you're in the 40% tax bracket, you save $4,000 in tax, right? And most of our physicians in JSMUAANA and our clients are in that highest 40% tax bracket. So the first reason you want to do it is the pre-tax. It is tax deductible. The
Mm.
second reason, what a lot of people don't realize, is that why do you want to do it is because if someone sues you, that money is protected. And a
Mm.
lot of physicians are concerned about lawsuits. Unless you're working for a big pharmaceutical company, if you
Yeah.
have your own practice, for example, I mean, that is a big concern for you. Like, what if I get sued? But
Yeah.
if you get sued and a lot of your assets are in places where they cannot be touched, that is a good place to be. So put your retirement, if you the money in the retirement account is protected, right? And the third reason is that it's a delay strategy. Now
Mm.
think about it. If you have $100,000, like a defined benefit plan, for example, you've heard me talk about that many times. But if you, let's say, put 100,000 in a defined benefit plan and you're in the 40% tax bracket and you save $40,000 in taxes, right?
Right.
That 40,000, if you had taken the money out, you would have had to give to Uncle Sam. But
Yeah.
this way, you kept that 40,000, it got invested, it grew. And in the stock market, if it's doubling every like 7 or 8 years, but then you're doing it every year and you're
Mm.
keeping the money and you keep growing it. So this is the power of tax deferred growth.
Right.
So the other advantage is that you're getting tax deferred growth of your money and you're making a good nest egg for your retirement.
But then later, when you want to take money out, at that time, what you're betting on that you are not at 40% bracket, maybe you have to give Uncle Sam lesser amount of percentage, correct?
Yes, that could also, sometimes it works out that way as well, because what happens is that in retirement, your earnings go down. So your tax bracket goes down. So
Okay.
then you also benefit from the tax bracket saving. So you saved it at the 40%, but when you're taking it out, for example, you're taking it out at 20%. So now
Mm.
you got the tax bracket saving as well. And when you take it out, Taki bhai, you don't ever take it out in a lump sum. You take a
Okay.
little bit out every
Okay.
year, and
Uh,
then you pay money based on your needs, and that's how you pay. So you delay paying the taxes for a long time.
okay, that sounds great. Yeah. Um, there is a question from the audience. Now that we're coming with the end of the year, so do you have some year-end tax saving strategies for physicians?
Yes, yes. There definitely there's definitely, and I also see some more questions here, so we'll get to the questions, but
Okay.
um, let's talk about the tax saving strategies for the end of the year. So
Okay. Yeah.
obviously, we spoke about the charitable lead annuity trust. That is definitely something for some people could be considered for the end of year planning, right? Then we are talking about retirement accounts. You know, you want to contribute to the retirement accounts because you want to maximize your deductions. Retirement accounts, there are various different types of retirement accounts. A lot of people have 401ks. They can contribute to that. Defined benefit plans where you can
Mm.
contribute a lot more. If you're not contributing to retirement account, then you should be looking to do so before the end of the year, and you
Okay.
should be exploring this because again, retirement contribution is a major way in which you can save money in taxes. The second thing that you can do is in certain states, there's a SALT workaround strategy that you could do. So when Trump came in, he limited the state and local tax deductions to $10,000. You can't deduct more than that when it
Mm.
comes to state and local taxes. So
Mm.
certain states like New York, for example, implemented a SALT workaround where if you're self-employed, you could pay the state and local taxes through the business and you could get the full deduction.
Mm.
So it's not automatic. You do have to elect for it, but that's something that you could also do. Then there's something called cost segregation analysis, where let's say if you have a building worth $1 million, you could do an accelerated depreciation, depreciate it over 10 years. You could get a $100,000 deduction every year. This works very well in the case of self-rental. So self-rental means that if you have a practice and you also own the building and you're
Mm.
renting to yourself, this works very well in those scenarios.
I see.
Then Zakat strategy, donor advice fund. We are doing this for a lot of our clients this year, especially right now in the month of December. So what happens is that you're giving money for Zakat every year, but let's say 2024 is a year where you're saying that my taxes are too high. So what you can do is you can prepay for Zakat. So you can, let's say, or charity, either or, you can pay for, let's say, 3 years worth of Zakat and put it into a donor advice fund. This way, the advantage is you get the full deduction this year in 2024. The money gets invested, it grows, and
Mm.
eventually you have to give it to an IRS recognized charity. If you
Mm.
have a stock that's gone up in value, like Apple or Nvidia, you could put the stock in the donor advice fund, and if it's long-term capital gains, you don't owe any taxes when you sell that as well. So that's an added advantage. And then just a couple of other real quick backdoor Roth IRA. This works for people. You make a post-tax IRA contribution, you immediately convert it to a Roth. Roth money is good for physicians because it's tax-free growth, tax-free withdrawals. And then College 529 is the most tax efficient way to save for your children's education because
Mm.
the money grows tax deferred and then the withdrawals are tax-free if you're using for qualified education expenses. And also in certain states, like for example, New York, you get a portion of the money is state tax deductible as well.
Okay, thank you for that question. I have myself, I have a private practice and I have some friends who have private practice. So I just wanted to know what is an optimal business structure for tax saving point of view between the S Corp and LLC?
Yes, Tekibai, I will answer that,
Okay,
and then let's after that question, let's
sure.
go to the Q&A because I see one, two, three, four questions over here. So let's
Okay.
answer that one, and then let's go to the audience Q&A.
Okay, okay,
Uh,
go ahead.
so yes. So all right. So let's talk about your question about what is the optimal structure for a physician practice.
Yeah.
Now, for most physician practices, I would say uh, the clients that we are dealing with is that an S corp structure for most physician practices is the most optimal, and I'll explain to you why.
Mhm.
Now, what happens is that if you have an LLC, whenever you take distributions from it, you pay payroll taxes. Payroll taxes is Social Security and Medicare. You're paying around 15% in payroll taxes, right? Now, if you have an S corp structure, and let's say in an S corp structure you're making $1 million, right? What happens is that you're also an employee in the S corporation. So
Mhm.
as an employee, you give yourself a salary. So in this case, you're making $1 million, you give yourself 500,000 as a salary, right? But then you're also a business owner. So you can take a profit distribution. That is what we call a K1 distribution. Now, the advantage is that on that K1 distribution, which in this example you're taking 500,000, you
Mhm.
do not owe any payroll taxes. So that Medicare tax rate for that level of income is about 3.8%. So 500,000, now you're almost saving like $19,000 in payroll taxes by doing this, right? So
Mhm.
if I've had real life situation where there was a client who was making $1 million and we converted to an S corp, and we saved that, and we did this 50-50% W2K1 split, and we saved about $19,000 every year in payroll taxes. So that is why for most of our clients, obviously it's case by case, but for
Mhm.
most of the clients that we are dealing with, we would say that the S corp structure is the optimal structure.
Okay.
So, Taqi I think we should go to some of the questions in the audience. I
So
think that, yeah, yeah,
go
go
ahead.
ahead.
You go ahead because I can see the question here.
Yeah. So the first question is, Salam everyone, this is Kamran Khan. Is there any timeline to refresh or renew the trust? Kamran Bhai, you would want to do it as soon as possible, right? So the trust is something that, you don't want to like delay this. You do want to take care of it ASAP. I think I mean, I've been in this business for over 20 years. Whenever I speak to people, the first thing that myself and my team always talk about is that if you haven't done the estate planning properly, take care of that properly. Just like doctors, you deal with human lives. We as financial advisors also deal with human lives. We've seen real life situations where clients have passed away where they haven't done their estate plan, and it is horrible. And then clients have passed away and they've done their estate plan, and it is a lot smoother from a financial point of view, although obviously the loss of life emotionally is always distressing.
Mhm.
Second question I see, Taki Bhai, over here
Yeah.
is please advise trust recommendation for late second marriage when both spouses have adult children from prior marriages and both are independent financially with their own homes. Very good question.
Good question. Yeah.
Very good question. So this is something that we deal with all the time. All right. And this is something we actually have a term for this, which is what we call blended family. All right, blended family means this situation which this person is describing over here, where they have a late second marriage, both spouses have adult children from prior marriages, and both are independent financially with their own homes. So in this case, you both would need separate trusts. One of the things, obviously, we would sit down with you and we would want to figure out what your wishes are. Sometimes in a late marriage like this, there's a prenup agreement that is there. So we want to see if you have that or not. But one of the things that we try to do in this situation, and we see this all the time, is that when you get married and let's say you have your own children, even though you're giving your spouse the funds, after you die, some assets, let's say you're giving your spouse, but you want to make sure that after the spouse passes away, the assets go to your bloodline, your children, not the spouse's children. So there's a provision that we put in there called Q-tip provision, which ensures that whatever assets you're giving to your spouse will eventually come back to your children. And again, I think one of the starting points for this discussion is that when we look at your assets, how do you want it to be distributed after you pass away? And then we want to do it in a tax efficient manner. So, for example, if you're going to give X amount of dollars to your spouse, you want to probably give them the retirement assets because it'll be more tax efficient. They could delay paying the taxes longer. So, in the case of a blended family, these considerations come into play, and this is something that our attorneys are taking care of all the time. I just last week worked on a blended family case with our attorney.
Okay. Yeah, I can see. So there is Zarish. She has a question. What are some of the ways you can take distributions without a big tax bill? Thinking about strategic Roth conversions.
Yeah, Zarish, strategic Roth conversions are a great idea, but you want to do it very strategically. You want to basically wait for the market to fall. All right. Right now, market is at an all-time high. So if you do a Roth conversion now, the taxes will be quite high. So what happens is that, and just for the benefit of other people that are listening, the Roth conversion is basically, let's say, if you have a pre-tax IRA that is worth about $1 million, and you basically say, all right, I'm going to convert it to a Roth and I'm going to pay the taxes now. Now it's converted to a Roth. Now, Tekibai, when you take the money out in retirement, no taxes due. That's the
Oh,
advantage because you paid it right now. So the
okay.
idea is that when you do the Roth conversion, do it when the market is down. So let's say the million becomes 500,000, convert it at that time so that then you pay less taxes and then all the subsequent growth and withdrawals are tax free. Or let's say you bought Tesla and Tesla falls, let's say like it did, right? You do it when it falls, convert it to Roth, pay the taxes on the low amount. Now Tesla after that, let's say doubles or triples, that growth is tax free. The withdrawals are tax free when you sell it as well. So strategic Roth conversions is definitely a good option.
Okay. Very nice. So I have another question from Khurram Chaudhary. Is 100% bonus depreciation likely to come back under Trump administration? And if so, will it be retroactive for properties bought in 23 or 24?
Yeah, so the 100% bonus depreciation could potentially be brought back, but as far as the vehicles are concerned, we spoke about this last time as well with Trump. If you buy a vehicle that, let's say, weighs over 1,000 pounds, over 6,000 pounds, and you're using it 100% for work, you can write off the entire cost of that vehicle as a business expense. This is the 100% bonus depreciation. Now, what happened is that expired, but we can still get pretty close to this through a combination of normal depreciation and bonus depreciation. So this is a case by case basis. We could discuss with you one on one, but we could get pretty close to that 100% depreciation through a combination of bonus depreciation and regular depreciation for 6,000 pound vehicle.
Okay, great. Thank you. And Zarish has a second question. If you take bonus depreciation upfront, doesn't it mean the rent will also be taxable in following years versus just taking it over 26 years, keeping rental income tax free? Only advantage is time, value of money, question mark.
No, no. So these are two different concepts, Zarish. So now I think when you say bonus depreciation, you are talking about. So remember, I'm talking about. So one is the bonus depreciation. We talked about the vehicle, right? Now let's talk about the cost segregation study, which is what we call talking about the building, right? That you're depreciating. So let me explain this concept to you, but if it is too technical, we can also do this one on one. Now, I'll explain an ideal scenario, right? Ideal scenario is, Taki bhai, you're a physician. Let's suppose you have your own building, right? And
Mm,
let's suppose you rent, you put that building in an LLC, all right? And your practice rents the office space from this LLC building, right? Now, this building, if it is worth $1 million, you take a bonus accelerated depreciation. You
okay.
get the engineers, they come and they do a cost segregation study. They, let's say, reduce the depreciation life of that building from 39 years to, let's say, 10 years. Now, that $1 million building, 10 years you're depreciating, you can deduct a $100,000 tax deduction every year. All right. Now, the advantage to you, because it's a self rental, is
Mm,
that typically your depreciation write-off would be limited to your rental income, right? But in this case, because it is a self-rental, that depreciation write-off it is considered active. And that depreciation write-off will flow through to the practice and offset the earnings from the practice itself. So in the case of a self-rental, this bonus depreciation concept works really well.
mm,
And sometimes we would take it a step further. Let's say that $1 million building, you depreciated it down to zero, right? Now you go and sell it. Now you owe taxes because your cost basis is zero.
mm,
But what we do there is that if you end up you hold this building, let's say for the rest of your life, you die and you pass it to your children,
mm,
they get what we call a step up in basis. So their price becomes the price at the time of your death. So let's say at that time, the price of your death, it is $1 million for that building. That cost basis, they will get it back and they turn around and sell it. They will not owe any capital gains taxes.
mm.
So
Interesting.
yeah, so it is conceptual and probably easier explained
Yeah.
with the graph and everything, but this bonus depreciation in real estate is a concept that can work very well if you use it properly.
Yeah, it was a little complicated. Yeah, but that's okay. You tried your best. Yeah, we got it. So Kamran has a little, clarification on his previous question. He's asking people who already have their trust, how often they need to renew it or review it.
I think have your attorney review it every 5 years or so, because Kamran bhai, your situation can change also, right? Your net worth can change, the rules can change. So have your attorney review it every 5 years and see if there's any updates that need to be done. If you need a more advanced type of estate planning because your net worth has grown, or if you or if the laws have changed and certain provisions in the trust need to be updated. So I would say look at it every 5 years or so.
Okay, excellent. And one more question. Arif Shafi, he has asked, can I contribute to HSA from my personal funds, or it has to come from my employer or my business?
So, the HSA typically is, so let's talk about what an HSA is, healthcare savings account. So HSA is if you have a high deductible insurance. So Arif bhai, if you're self-employed or if your employer offers it, it is usually through the employer that you get your health insurance. But if it's self-employed, then you're the employer also, but it's through the employer that you get that. Now, the high deductible health insurance, typically it makes sense to have an HSA account. In an HSA account, you can put about roughly around $8,000 pre-tax into the HSA account, and you can use it for medical expenses. And if you don't use it, it can get invested and it can grow, and eventually you can use it as a long-term care benefit after a certain age. So the HSA does make a lot of sense. I have a client who's developed a health situation later on in life, but they have a very sizable amount of HSA money. So that's going to help them.
Mhm.
So I think HSA contributing to it makes sense, but your health insurance through your employer, whether you're working for someone or whether you're self-employed, that plan does need to offer the HSA.
Okay. All right, we'll have another question from Zarish. I did estate planning then the law office disbanded. The lawyer told me that I could just do updates on the Word document. No need to file anywhere as long as there are signatures with updates and paperwork is all in one place. Is what do you feel about that?
Um, yeah, I think
A little,
doesn't look like sound like very solid advice. So we can take a look at this. We can discuss it one on one and have our attorneys
okay.
review it. Yeah,
All right.
we could do a complimentary review of
Okay.
that.
Perfect. Thank you. Uh, and Khurram has a follow-up question. This is specifically for real estate properties.
Yeah.
And
Yeah.
his initial question was 100% bonus discussion likely to come back under Trump
So
administration.
I think we explained that
Okay,
Takibai, in the
perfect.
cost segregation
All right,
discussion.
excellent. Okay, so I have one question for you. What is your post-election market outlook? How should investors prepare for that with the new administration?
So I think, Ji, as far as post-election outlook is concerned, I mean, uh, sent out a video of one of my interviews on CNBC where I've discussed this in length. But I do want to discuss one point in particular with the audience. And that point in particular is that there's a lot of concentration risks in portfolios that we are seeing right now. And we are being very mindful of this, but a lot of people are invested very heavily in technology. And technology has gone up a lot, and it is trading at very, very high valuations. And what we are seeing is that with Trump coming in, there are certain other areas of the market we think are going to do better. So, for example, with this deregulation that's going to happen, we think that banks, financials will do well. Energy, oil companies will do well. Utilities, electricity producing companies will do well because artificial intelligence consumes a huge amount of electricity, right? So, but what we are seeing is that, people are buying Nvidia like crazy, Google, Apple.
Mhm.
A lot of times I'll see sometimes a prospective client, they'll send me their statement. Once or twice, a couple of times I've seen that the whole account is in Nvidia.
Oh,
It's very, very, very dangerous. And then what is also happening is that because people are not rebalancing their portfolios, tech has gone up. So suddenly, I mean, if you're buying the S&P 500 index fund, that in itself is more than 40% tech related, right? But then a lot of people are buying these companies individually. Then their accounts are scattered. They have some money in a 401k, some money they're managing themselves. They can't monitor their tech exposure. And now what we've started to see is that money tech is underperforming, but other areas of the market are doing better, right? And we feel that, no matter how good a company it is, this is like a public service announcement. Nvidia might be a great company, but that doesn't mean that it cannot fall. GE was a great company, it fell more than 87%, right? Citigroup was a great company, it fell more than 92%. When the NASDAQ fell after the tech bubble, it took 14 years for it to recover and get back to even. So if you find yourself in a position where you're heavily invested in technology, understand that the market is at an all-time high. It is possible when the government changes next year, there could be some pullback in the market, and technology companies could be very vulnerable to a pullback. So you want to still have some tech exposure. We're not saying don't have tech exposure. These are still good companies, but diversify and improve the breadth of your portfolio so that if the market falls, you can sustain it and continue to grow your portfolio in the long term.
okay, excellent. Um, there is this will be the last question. Okay, Ado.
Ji.
Uh, so, as a physician, should be concerned about our asset protection. What are some asset protection strategies that physician can use?
Yeah, we can definitely. One other thing, Taki bhai, that I wanted to also mention before
Yeah.
we get to asset protection is We were talking about Sharia compliant estate planning. Sharia compliant investments is also something that we can help people with. And with that, we use the guidelines provided by the FIC Council of North America for Sharia compliant investments, where you can avoid alcohol, pork, pornography, banks, bonds, companies that have a lot of debt. You can avoid that. And typically, what we are seeing with some Sharia compliant portfolios is they're very risk heavy. So they're very tech heavy. So we try to, because they don't invest in bonds. So our Sharia portfolios, we try to keep about 15% in cash, 5% in gold, 2% in the Amana Participant Fund, which is a bond equivalent fund, but it's Sukuk, it's leaseback arrangements. So this way we can make Sharia compliant portfolios moderate as well. So I've met a lot of JSMUAANA prospective clients that are interested in Sharia compliant investments. So I wanted to make sure that we mention that this is something that we can help with as well. So sorry, just getting back to your question about the asset protection. I think for physicians, asset protection is very important. And it really depends on your situation, how we can achieve it, right? Whenever we talk about, and you may have heard me give this example before, when we talk about asset protection, it's like wearing a bulletproof vest, right? You can still get shot, but if you have asset protection, it may not be fatal, right? So you always want to create deterrence. Now, one of the deterrents, for example, in states like Florida and states like New Jersey, there's a special type of ownership between a husband and wife called joint tenancy by entirety. If you own anything under that special type of ownership, it is lawsuit protected. So, for assets that are in that state. So, what we do is we put that provision in the trust document. So, through the trust, you get the asset protection. Retirement assets, they are lawsuit protected. So, we want to maximize the retirement assets. If you have rental properties, always put them in LLCs so that your liability is limited to the ownership in the LLC. Because if a tenant falls, breaks his or her leg, or sues you, then your liability is limited to whatever is in the LLC. They can't come after your personal assets. So we want to make sure, I mean, sometimes it's not rocket science, Taki bhai, sometimes it's very simple, but you do want to have a conversation with your advisor and figure out, all right, this is my net worth, 5 million, 10 million, 20 million, 30 million, whatever it is. How do I protect this? Because I've worked hard to grow this. Now, how do I make sure that it is protected as well? That is a very important conversation.
Okay, excellent. Uh, well, if our JSMUAANA members, they want to reach out to you, what is that? Where they can reach out to you?
Okay, yeah. I mean, I'd be happy to help. JSMUAANA is like family, almost family to us. I mean, we are there all the time. But the best way to reach out to us, you can go to our website, www.wallstreetag.com. I'm displaying it on the screen. Click on the Contact Us button on the top menu, put your information there. We'll reach out, schedule a time with me to speak, or you can call directly 917-208-0129, and we would be happy to help. We're a team of fiduciaries. We specialize in financial planning for physician families. So we'd be more than happy to speak to you individually and help you with your financial planning needs.
Very good. Adil, I really want to thank you on behalf of JSMUAANA. Thank you for being our, continuous supporter in our programs, and you have been sponsoring programs that have been helping a lot. So for our audience, just wanted to let you guys know, Adil, we have been working like 10, 15 years now together, and he's always there to help any type of financial, support, or financial, education, if you guys need. And we will continue our partnership, Adil, Wall Street and JSMUAANA. I will long live. I will go
Thank you.
long time. And everyone who are on the call today, thank you very much for joining. I hope I learned a lot. You all have some updated information and something you all learned out of it. And again, reach out directly to Ado if you need any help. And I am Taqi Azam. Thank you very much. Inshallah, we'll see you guys on our next webinar.
Thank you, Taki Bhai. We really appreciate it. Thank you,
No
everyone.
problem. Welcome.
Okay.